Sure. So in general, I think diversification is critical for anyone who wants to be on the safe side, especially considering where we are in the economy now. I mean, a lot of people are predicting that we're going to hit a recession sometime soon, but that soon could be a month from now, or it could be 2 or 3 years from now. No one can predict that. That's why diversifying your portfolio, not only out of Wall Street, but also across multiple asset classes is very, very helpful.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome again to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. Today we have a very special guest, Alina Trigub from Fair Lawn, New Jersey. She's a syndicator and educator, and who will be talking to us about many different topics, but most importantly, the importance of diversifying your passive investment real estate and the kind of the benefits and the importance of doing that. Before we get started, just want to give a little bit of context and just a little mini bio, and then later I will have Alina get a little bit deeper to her background so we can, I think will be the perfect segue into our discussion. Alina is a former tax accountant at Ernst Young, is the founder and managing partner of SAMO Financial, a boutique private equity firm specializing in helping accredited investors find passive real estate investments. Alina is also the founder of two very popular meetup groups called The Power of Passive Investing Through Real Estate, which gathers in New York and New Jersey. And she also hosts a virtual meetup for women by the same name. She has helped her clients diversify and invest in over 1,100 multifamily units, over 500 self-storage units, and a $5 million mobile home park fund. Alina, thank you for joining us and welcome to the show.
Hello, Dwaine. Hi, everyone. Dwaine, thank you so much for having me on your show. I'm thrilled to be here, and it's really a pleasure to be part of your podcast.
Yeah, I appreciate it. So we talked before, and you just have a great background, but I think it'll just be a perfect segue into our discussion if you could just give a little bit of more history and background of yourself.
Sure, absolutely. So as Dwaine mentioned, I'm a former tax accountant with Big Four experience, and later in life I switched to the information technology world. And while I was going through that switch and later working in technology and even working in accounting, I realized that it's all about people, that we are for the most part working with other people, and that's why to make things happen in life, to achieve anything, you have to make sure that you establish relationship with other people and make it more about them than anything else. That helps build strong relationships, strong partnerships, and it brings a lot of allies for you in general. So while I was working as a former tax accountant, I was always looking for tax saving strategies, ways to save on taxes and ways to preserve wealth. And real estate's been on my mind for many, many years. And finally, about 6.5 years ago, I decided to take action, and I did my extensive research and came across the world of syndications. It was a fascinating topic, fascinating niche. So after doing additional research on syndications, I took action finally and started investing as a limited partner into someone else's deals. And after doing it for several years, I realized the benefits of passive investing through wealth preservation, tax savings, and then generating passive income. And out of this, the idea of my own company was born. And that's how I created SAMO Financial, with the sole purpose in life to help other people so they could also preserve their wealth, save on taxes, and generate passive income through syndication. So that's what I've been doing now, working with a lot of folks that are either busy business professional or busy business owners and don't necessarily have the bandwidth to do real estate or don't even want to do real estate, but are very happy to diversify out of Wall Street and have a fully diversified portfolio that not only includes stock, bonds, and mutual funds, but also includes real estate investments. And these investments for my investors and myself now include multifamily, storage units, and mobile home parks. And I constantly look at other asset classes, constantly doing research and looking into other things as well. So for instance, now I'm researching senior facility and deciding whether that's another asset that my investors and myself will be adding to our portfolio down the road. So
that's very interesting. We do a lot of syndications and brokerage as well, and we work with a lot of business professionals, lawyers, doctors, accountants, and like you were just saying, it takes a lot of time to learn about real estate investing, all the nuances. There's so many parts into getting into a deal, analyzing it. Some people have to go visit it, interviewing sponsors, finding the right fit. So you kind of take that role of kind of doing all that work for them, and it's kind of giving them the full package. And just with your background as an accountant and MBA in finance and real estate researcher and expert, you kind of take that load off of their back and kind of give them that, along with educating. I hear with your meetup groups and your different educational seminars that you're just providing so much value and education to people to feel comfortable to get into these types of investments.
Absolutely, Dwaine. It's my pleasure. I like to see the smile on people's faces. I like to see the return on my investment, if you will, when someone comes to me and they've never heard of syndications, and then they get enlightened, and I send them the educational materials, books, articles, and so forth that they need to read up to understand what it is, and then we go through the Q&A, and I take them through this whole process and help them get acclimated with syndications in general, and so that they can start investing for themselves and their families. So it really does brighten my day to see the happy smiles on my investor faces.
Yeah, absolutely. And you talk about the different asset classes that you're involved in. I know some investors, they just deal strictly with multifamily. Some people just do self-storage or mobile home parks, and they have this one particular niche, but you kind of look at a different array of investments. And I think there's many benefits to that, diversifying your investments. Some people think just having stocks in different type of sectors is diversified. And we always talk more about getting out of it into actual physical assets. Can you talk a little bit about the ones that you had mentioned before regarding the different asset classes and the benefits of diversifying?
Absolutely. Just like majority of people, I personally started investing in multifamily because it's close to home. I lived in apartment buildings at some point in my life, and I understood this asset class very well. I know that a lot of people need to have roof over their heads, and that's why I looked at multifamily as one of the essentials. And while selecting the investment, I was always looking at the areas where majority of working folks would live. So I wouldn't necessarily look at the extremes, like really bad neighborhoods or very luxury neighborhoods. I looked at the bread and butter, if you will, the neighborhoods where most of the working people would live, and that's where people would want to rent out and live in apartments. So that's how I chose the multifamily as our first asset class. But over the years, as we were bringing more and more investors in, and I started getting questions about diversification, I thought that it made perfect sense to add other asset classes to our portfolio. So as I was doing my research, I realized that there are other asset classes that are also as conservative, if not more, as multifamily. And first, I came across storages, which a lot of people use during the recession because a lot of people have to downsize when they cannot afford their larger homes. And when they're downsizing, obviously, they put away a lot of their belongings into storage with the hopes of taking it back at some point when they go back to buying that larger house after the recession is gone. And the next asset class that we looked at was mobile home parks. Again, it's one of the safest asset classes out there. It has one of the lowest expenses in general, because if you think of it, when you're buying a mobile home park, most people try to buy the parks that have either all of the mobile homes or majority of the mobile homes owned by the tenants. If that's not the case, then they offer it as lease to own so the tenants can buy them eventually. What that entails is that the mobile home park owner is left with very few expenses, very little on plumbing or electric side, and that helps to keep the expenses very, very low, and that helps to bring the income of that property up. So that's another asset class that we really like, and our investors like it as well, and it helps us to diversify across multiple asset classes that way.
Yeah, it's very interesting. I'm starting to learn more about the mobile home parks and self-storage investments. And like I said, that's very, very smart, particularly as we have a very cyclical, fast-moving, I would say, economic market where, some things just change. And, historically, people would say we have a recessionary period every 7 to 10 years. So it's very smart to look at these different asset classes that kind of fit perfectly within those movements of the economy. So overall, if you spread out your capital amongst these different assets, that you'd be kind of covered and kind of, is more of a safer bet instead of having all of your eggs in one basket. And that's very important, especially for people who are working and are used to getting, income, and they're, saving for their family, saving for retirement. That money is very important to them. So they don't really want to say we're going to have money all in multifamily, but we also have it spread out to other different real estate asset classes that, will mitigate that risk. So I think that's very important.
Yep, absolutely agreed.
Can you talk, I kind of explained a little bit about the kind of importance of diversification. Is there any other reasons that investors should be looking at other different types of asset classes? And you also mentioned senior housing or assisted living, which is a new thing that you're researching. Can you kind of explain the benefits of investing in that type of investment class?
Sure. So in general, I think diversification is critical for anyone who wants to be on the safe side, especially considering where we are in the economy now. I mean, a lot of people are predicting that we're going to hit a recession sometime soon, but that soon could be a month from now, or it could be 2 or 3 years from now. No one can predict that. That's why diversifying your portfolio, not only out of Wall Street, but also across multiple asset classes, is very, very helpful because you help to balance it out. If, let's say, multifamily is not performing too well or is not appreciating too well, as long as it's cash flowing and as long as it's stabilized, it's okay, and it's good for investors. But by the same token, if you know that there is that other asset class, for instance, storage, that's thriving and performing better than any other asset class during the recession, then you would want to invest in that asset class to make sure that you reap the rewards of being part of the portfolio that is in the asset class that performs best during the recession. In terms of the assisted living as an asset class, so I'm more or less at the beginning of my research, but so far what I see is aging population is on the increase. There is no way to avoid it. I mean, I know we're entering the world of artificial intelligence and everything goes through the technology and stuff, but there is no way for us humans to avoid getting older. Mm-hmm. And the number of senior citizens is increasing every single year. And what I also found out, not all of senior citizens are moving to the Floridas and Arizonas of the world. Some prefer to stay close to their kids. And what that entails is that there is a potential for people like myself who live in a very expensive market like Northern New Jersey, which is close to New York City, to potentially start investing close to home and find investments that are still cash flowing while close to home, because I do have some investors that are not that comfortable either going out of state or going too far out of state where they would not be able to drive over and see the property themselves. So I think this asset class will allow us to potentially have some investments locally to benefit such audience that's a lot more conservative and prefer to have the assets that local to home. That will also benefit a lot of seniors because we want to find the investments that are that are helping seniors to live in thriving environments and help them to find a place that reminds them of a home, because the type of assisted living that we want to invest would be more or less a residential assisted living that reminds seniors of their home more than anything else.
Yeah, very good. As a syndicator, and I bet you're looking at a lot of different deals, talking to a lot of sponsors. Kind of, what is your criteria for looking at, say, a multifamily deal? What are the type of indicators that you're looking at, market-wise, asset level-wise, and all those different things in order to make it a potential acquisition for your group?
Sure, absolutely, Dwaine. So when I look at the specific asset class, there are several components that I take into consideration. First of all, where is the asset is located, and if it's an apartment complex, how close is it to the highway? I look at the town population. I look at the metropolitan area population. Is the population increasing or decreasing? Then I check the job market. What's going on? Are the jobs increasing or decreasing? And then I look at the major employers in the area. These employers that are there to stay, and they're not going to be kicked out by the next Amazon in the next few years. So that's also very, very critical. So that would entail that I want to see some major hospitals, major universities in the area. Then I also check for the infrastructure. In addition to the highways, is there access by plane? Is there airport or two in the area that allows us to easily access the market? Plus, again, given where we are in the economy, I tend to stay away from tertiary markets and concentrate more on secondary or primary markets. So what that entails is, if it's a smaller town, I tend to look as to how far or how close is it located to the major metropolitan area. And if it's, let's say, within an hour commute, that's still fine, because most folks would commute for an hour to their jobs. But if it's further out on the outskirts of an MSA, or like over 2 hours commute, I would definitely cross that out completely. In terms of deals, again, my preference hasn't changed. I prefer to stick to the so-called bread and butter of the investment offerings. So I don't look at the extremes, on the two extremes, the really bad neighborhoods and really good neighborhoods, but I stick to the decent neighborhoods where most folks live. Or let's say if it's a storage, I want it to be very close to the highway, easily accessible, ideally that people could see it from the highway, because that will give storage visibility, and the demand will increase as well. In terms of mobile home parks, when I look at that asset class, what's important to me is the demographics of the area, and then the rents in the area. Normally, the mobile home parks that we're buying are located in the areas where the rents for apartments are too expensive, and that's why these families are switching to mobile home parks as a more economic alternative, while they can still have their home close in a good area close by for the kids to go to school in the area. Or maybe it's senior citizens that prefer to live in the area but want something that's a lot more economical than renting an apartment that's expensive. So those are some of the criteria, definitely not all, but some of the main criteria that I look at when evaluating each of the asset classes that we're in right now.
As far as the sponsors that you work with, what is kind of the criteria of, say, doing your due diligence on them and seeing if it's a good fit? Because ultimately, you're representing a lot of investors. You have a lot of, the relationship with them, so that's very important. So, matching those pairs is also a critical piece because you want to make sure that the money is safe and who they're working with is credible. Can you walk us through kind of your process of evaluating sponsors for potentially doing business with?
Sure, sure. So it's important for me to have a complete alignment with the sponsor. But before I even get to that, I check their track record, their background, education, and whatever shared with me verbally. I do due diligence on that to make sure that everything they mentioned checks off. Outside of that, we discuss the strategy that they're implementing, and I always evaluate their portfolio that they already have and the plans that they are having for the investment that they are potentially interested in offering to my investors. Again, to make sure that our strategy is aligned and the plan that they have for investment in terms of value adds and then doing the potential capital events down the road, that they also make sense and it's something that would benefit my investors. So those are some of the things that are very, very critical to me. In addition to that, the personality. So I want to work with the sponsor for many years ahead. And if I see that there is some sort of misalignment in personality, some sort of clashes, which does happen occasionally, not too often, but we're all humans. We all have our own interests and personalities. So when it happens, then I decide not to go with that person. And it doesn't necessarily mean that the person on the other end is good or bad. It just personalities clash. Yeah, so that can happen as well. So those are some of the main key components that I look at. So personalities, background, professional education background, the track record, and then the offering, how safe the offering is, how realistic the value add strategy is. And I do my check marks to see whether the property will prove to continue to cash flow after we hit the recession.
Yeah, you kind of mentioned working with different types of investors, and they have particular different needs. So the sponsors that you're looking at, their deals, they may have different returns and stuff like that. Are you looking for a set amount of return for your investors, or does it differ per deal based off of the needs of a particular investors that you're working with?
Sure. So the returns always differ, and I tell my investors to always look at the big picture. Don't just look at one number, say IRR or cash on cash. Always look at everything together. See what the cash flow is from year to year. Is it increasing? Is it low at the beginning, and is it getting higher year over year? What the IRR is and how many years is the underwriting done for, because all of those key quantitative components have to be taken into consideration in conjunction with each other. Equity multiple could be 1.9 or it could be 2.9, but if that 2.9 because the value add strategy is too aggressive and because the sponsors are saying I'm not going to have any vacancies, the vacancy is set at say 2 or 3%, and it's not realistic for the area, that it certainly is a red flag for me and I'm not going to look at the deal. Or if I see the deal where in addition to the regular loan, let's say they have a bridge loan for a few years, to me that's potentially a yellow flag, something to look into further. Why do they have this bridge loan in the meantime? Because you have to take into consideration where we are with the economy and go through various what-if scenarios,
Mm-hmm.
And in addition to having a plan, you always have to have a plan B and plan C, if you will. So always have a backup and a backup to the backup plans, if you will. It's very, very critical knowing where we are. And there is a lot of research and a lot of history as to what's been happening with past recessions. No one can predict how deep or how low this recession is going to be. So it's very important to play for the worst case scenarios and see what's going to happen. If the property still shows as if it's going to continue to cash flow, then it's a good indicator of potentially going with the deal. And that's what I go by as well.
Yeah, it's very important. I know a lot of syndicators, I look at a lot of different deals because we do some passive investments as well. Some of the syndicators don't really do a strenuous stress test on their numbers. to compensate for the potential of whenever this recession or adjustment in the marketplace is going to be, and they're really just trying to raise money and buy a deal. I also look at some red flags if they're giving too much of the profit share away. That means they don't have much skin in the game. You want to have kind of a balance where both the syndicator is motivated and compensated for the work and time that he's putting in. Also giving a fair share to the investors that's providing the capital and the risk of putting up their money, among any things. And of course, doing the background checks on them and making sure they have a good track record is extremely important. Because like I said, it's, for many people, $25,000, $50,000 is a lot of money. They're working, full-time jobs, and they're trusting people pulling money out of the stock market to get a good return, to get long-term cash flow. So it's very important that they get, that it is done properly and that they're satisfied at the end of the day. So I think you're taking the perfect approach, and that's the way that everyone should be doing it.
Thank you, Dwaine. Thanks. I appreciate that. I can definitely relate to those people. I was in their shoes once before. When I started out, my very first several investments have been done with the syndicators that I've never met in person. I've never seen the properties in person. Everything was through Google Earth, talking to people on the phone and validating all the information they gave over the internet. So yeah, internet is a beautiful thing. It allows you to do a lot of research without leaving your desk. But it's scary when you rely on it to put your hard-earned money into someone else's deal. So yeah, completely.
Yes, yeah, particularly, like I said, you have experience on both sides, being a past investor and also the syndicator. So you're in that shoe, so you know exactly how another person with their hard-earned money is going to feel. So it's very important that you're taking all of the correct steps as if you were you were investing your own money. So so you meet with a lot of investors. Is it each week or each month for your meetup groups?
Our meetups meet once a month. I do meet investors and talk to investors almost on a daily basis. People reach out, whether it's through social media, through my website, or through bigger pockets, or not these days. It's a lot of word of mouth. So a lot of people that have already invested with me and trust me, they started referring their friends and family and neighbors to me. So I do talk to a lot of folks nationwide, almost every day.
That's good. So, doing the different meetup groups, you talk to a lot of investors. There's a lot of dialogue back and forth. Is there like a frequent question that always gets asked of you that you see, that you're always answering?
Yeah, some of the frequent questions include, how soon will I get my money back? And what I try to explain to investors that our strategy is to add value to the property. And what it means is we're buying assets that require some sort of repositioning. And the larger the asset, the more extensive renovation in a lot of cases can be. Not all the time, but in a lot of cases. What it entails is that until we take the time to fully reposition the asset and put in place everything we wanted to, whether it's new kitchens, new bathrooms for all 100+ units, or maybe it's brand new roof or a brand new children playground, until that's all done and we can go back to the bank and say, here, you can see we've done the repositioning, the property has appreciated in value, can you give us some equity back? Until that point, they should not be expecting to get back any principal, but we do promise them to pay the dividends. And again, I say promise because just like any investment, this investment is not 100% guaranteed. We do the projections. These projections are based on the actual data because we take the actual income statements and the actual rent roll that's provided to us by the sellers. And based on that, we do the projections into the future because we know what is a typical rent increase in the area. We know what can an average expense increase be in the area, and based on that the projections are calculated, but nothing is guaranteed. And I always stress that out. And another thing that I stress out to people is when they say, oh, I have 50,000 I'd like to invest, I always ask them, is it your last 50,000? Have you saved the money for your rainy day if you need that? Is this money that are specifically allocated for the investment? Because the last thing I want to do is take the last 50K or whatever the amount is from this person, and then 6 months from now or a year from now, they'll come back and say, hey, give me my money back. I need it for something else. And I will not even take that investor if they tell me that this is the last resort that I have. I want everyone to have the money saved for the rainy day, and then save more money and add more money for the investment, and only the money that is specifically allocated for the investment can be invested. Otherwise, I wouldn't even take the investor in.
Yeah, absolutely. That's a good thing that you kind of talk to them, interview them, and kind of ask them those critical questions. Because like I said, you never know. I deal with investors that they like the cash flow, but they don't need it in order to live their lifestyle. They have other income coming in, or they have savings on the side.
Sure.
Just kind of look at it as from a future money standpoint. You're going to get cash flow, appreciation, the tax benefits, but you're really just looking at it from additional money that you have to put towards investments like that. A lot of people have money that's tied up in the stock market that wants to pull out cash there. That may be some possibility, because most people are not, like day traders where they're just, putting in, putting out, putting in, putting out all the time.
Yep.
So, as long as they have a self-directed IRA that I know that you're very familiar with, that they have retirement funds that are just separate and dedicated for that purpose. Those are the appropriate funds for these types of investments. And that's something that's very important that you're explaining to the investors.
Absolutely.
As far as the properties that you're dealing with now, what markets are they located? Could you share that?
Sure. So we buy properties nationwide. We try to concentrate on the market that have all of the components that I mentioned in the past checked off. So it's population growth, job market growth, major employers in the area, infrastructure, access to highways, and areas that can allow us for properties appreciation. So such markets as Texas, Florida, Carolinas, Arizona. Those are just some of the states where we go and where we buy our properties.
So when you're not doing meeting with investors, talking to investors, doing education, what is Alina doing in her off time?
So I spend my off time with my family, my kids, taking them through activities, watching them play or watching them compete in their competitions. So that's the love of my life.
Oh, very good. Yeah, like I said, like the way I mentioned before the interview, I have 2 small kids, and I see them every single day, take them to school. We go to different trips. We're going to Europe this summer. So like I said, the family is very big for me. And that's why the main reason I got into real estate is to create this lifestyle that I'm not fully depending on a day-to-day type of job. Where you just constantly grinding. You need that passive income. You need different forms of passive investments to supplement, and you can be able to do the things that you love.
Absolutely.
I know that you have a very strong educational background. MBA and also working at Ernst Young. What other educational material or books that you have read that kind of help you to get to this position now that you're syndicating larger deals?
Sure. So yeah, I spent significant amount of time educating myself on buying properties, commercial real estate, syndications in general. And obviously, when it comes to books, everyone had read the Purple Book, and it had changed a lot of lives, including myself as well. But when it comes to other books that I feel very, very critical and important to read, one of the oldest books that has been around for ages is The Richest Man in Babylon. While the book is very old, the concept is not. It's phenomenal. And for anyone interested in becoming a real estate investor or some sort of entrepreneur, I believe that's a must to read book in general. So The Richest Man in Babylon.
Yeah, I always ask this question to other people I'm doing interviews, because I have like a little library in my office, and like every time they mention about it, I go out and get it. And it's just, I think it is education. Compared to how the traditional educational system here in the United States, not to say there's nothing wrong with it, but you need that supplemental education either through books, through getting a mentor or coach, attending seminars, or going to meetup groups like yours, where you just interacting with other investors, or if you have special guests that's speaking on a particular topic, to just learn more. And you just always got to kind of expand yourself. And especially when you get into these types of investments, you really have to educate yourself. Even if you're just going to be a passive investor, you want to learn, is this actually a good deal? Or all of the stuff that the syndicator is telling me, I believe it, because you kind of have that formal education of, training yourself. So
Exactly.
very crucial. Another question is, what's kind of like your routine? I know that you're doing the syndication, you do the meetup groups, and doing a whole bunch of different types of projects. I know investors that have, full-time lives, they kind of like to learn more about your process so they can get more done during the day, so they can take advantage of these opportunities.
Sure. So is the question more about the morning routine, what I do in the morning?
Yeah, what you do to kind of get so much done, in order to kind of prepare to possibly get into these types of investment opportunities.
Sure. So another great book that I read several years ago is Miracle Morning. And after I read that book, I kind of modified the routine that was suggested in the book to my own routine. So every morning I do some exercising, I take a cold shower, and then I evaluate my goals that I've set for the next 3 to 6 months. And I kind of try to pull out the steps that I can do today to get myself closer to reaching those goals that I set for myself. Mm-hmm. I also do meditation, and then I get myself going for the day. And, doing physical exercising and meditating, I would say, are two of the most critical components that help me not only get through the day, but also stay energized and stay positive throughout the day, and look ahead into the bright future.
That's a good advice. So what are some, I know you talk to a lot of investors. What are some advice that you say, like a new investor comes into one of your meetup groups and you say, I'm starting out, what do I do? What's your advice for them?
I would send them to my library and ask them to get educated. They should read about real estate in general, and they should determine what kind of niche is best for them. But before they even pick a niche, they have to determine whether they want to be active or passive investors. So that's step number one. And step number two, once they know whether they want to be active or passive, then they need to look into multiple niches and pick one that suits them best. And they want them to concentrate on one niche at a time. It will help them expedite the process for themselves.
Is there any other resources that you can recommend? Any besides the meetups, any forum groups or educational pieces that they can pick up along the way that you can share with the listeners that they can maybe download while they're listening to this call?
Sure. I recommend, in addition to listening to your podcast, Dwaine, I recommend listeners to go on Bigger Pockets, check out their website, their podcast. There are many other informational materials, lots of books that I would recommend, and just continue reading, speaking with other investors, and educating yourself as much as possible. And the final step is taking action. It's very, very critical once you educate yourself to take that action.
Yeah, absolutely. One thing I said, just enjoyed, talking to you the time we spoke on the phone. You're just a very nice person. I can tell that you just like giving, like I said, through education and just talking to people. It just seemed like you'll take a call with anybody and just kind of give them advice. And I think that's just crucial, especially in this type of world where, sometimes we're seem type of divided, but we just need to talk to each other, help each other, and everyone's just, get to the same goal. How do people get in touch with you? Do you have a website, phone number, or any other contact information you could share with us?
Sure. So then, first of all, I want to thank you for your kind words. It means a lot to me, and I am open to helping other folks in whatever journey they want to start. In terms of reaching out to me, I have a website, samofinancial.com. I'm reachable through that, or through social media, whether it's Bigger Pockets, Facebook, or LinkedIn. People can find me anywhere.
All right, perfect. Well, again, it was a joy. It was great talking to you. You're such a nice person. I look forward to meeting you in person at your New Jersey or New York events in the future. and I'll hopefully have you back on the show to talk about additional topics. It was a pleasure for our audience, so I appreciate your time, and I look forward to talking to you again.
Dwaine, it's totally my pleasure. Thank you very much for inviting me and for interviewing me on your show. And it's a pleasure speaking with you as well.
All right. Thank you. Have a great day.
You too. Thanks.
Bye-bye.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.